Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my initial research checklist. Today, we're shining the spotlight on Veeva Systems, ticker symbol VEEV, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. So far, I have screened 244 stocks across 9 sectors and 71 industries, with a median quality score of 61% and a top quartile benchmark of 70%. Veeva was scored in November 25 and received a 75% quality score, good enough for 84th percentile overall and a pass status. Data used for this episode is as of Q3 2026. All right, let's now get into the business. Veeva is in the healthcare information and technology industry within the larger healthcare sector. Their market cap was $37 billion as of January 27th, 2026, which would be a large cap classification. And trailing 12-month revenue was around $3.2 billion with a beta of 1.07. Veeva started as a Salesforce-based CRM for pharma, but has deliberately evolved into a vertically integrated industry cloud built specifically for life sciences. What began as a distribution shortcut through Salesforce turned into a long-term strategy to own the full platform, deepen customer lock-in, and expand across every critical workflow in the industry. Importantly, almost all of Veeva's growth has been organic, driven by expanding platform adoption, high retention, and deeper wallet share rather than big acquisitions. Today, Veeva sits in the scaled compounder phase, operating as the core operating platform for life sciences with long-term contracts and high switching costs. In 2021, Veeva also reincorporated as a public benefit corporation, signaling a long-term orientation focused on customer trust and stakeholder alignment rather than just short-term optimization. Instead of just one app, they provide an integrated platform that runs drug development and clinical trials, regulatory and quality compliance, commercial sales and medical engagement, and the data layer that connects it all. Under the hood, there are 4 main clouds. The first, Development Cloud, for R&D, clinical trials, safety, and regulatory workflows. The second, Quality Cloud, for manufacturing quality, compliance, and audits. Third, the Commercial Cloud, for CRM, marketing, and medical affairs. Fourth, the Data Cloud, as the embedded data layer, powering planning, targeting, and analytics. On top of that, they've added business consulting to help customers implement and optimize these workflows. And they're also embedding Veeva AI with AI agents built directly into the Vault platform. To me, the value proposition is simple: one compliant, industry-specific platform that replaces fragmented legacy systems and manual processes across the entire drug lifecycle. In terms of who they sell to, Veeva is a pure B2B software provider with a customer base concentrated in the biopharma segment, which is around 94% of their business, followed by medtech at 4% and consumer health at 2%. Within biopharma, their customers span the full spectrum from the top 20 global pharma companies, which is around 50%, to mid-sized enterprises at around 15%, and small enterprises at around 35%. CFRA rates Veeva as a medium risk profile, pointing to strong balance sheet with negligible debt, high visible subscription revenue, and high switching cost, while Morningstar flags high uncertainty, mainly due to macro pressure on biotech funding, commercial CRM making up around a third of revenue, and slower new customer growth as most large pharma has already adopted. Looking at their revenue generation and quality, I do rate their revenue as high quality, and it comes from 2 primary streams. The first, subscription services, which are usually 1-year contracts, but they are recurring, predictable, and ratable. This is the core engine of the business, and it makes up around 80% of revenue. The other 20% is professional services. Key growth drivers inside subscriptions include the number of customers, seats and usage, and most importantly, products per customer. Not surprisingly, subscription revenue is recognized ratably over the non-cancelable contract term, while professional services is mostly recognized over time as work is performed. I do rate Veeva as having strong pricing power, driven by the mission criticalness of their products. Its software would typically sit within IT and operating expense budgets and represents a really small percentage of a pharma company's overall cost structure. Yet it directly supports regulatory compliance, drug approvals, and ultimately revenue generation. Looking at their moat, most sources will say that Veeva has a wide moat, driven mainly by high switching cost and deep workflow embedment. Its Vault platform spans clinical, regulatory, quality, safety, and commercial functions on a unified system that sits at the highest risk points of the drug development lifecycle. Once embedded, switching is complex, disruptive, and it carries regulatory and operational risk. Even with AI concerns heading into 2026, the moat is reinforced as AI is currently being embedded directly into its regulated platform where trust and compliance matter most. Turning our attention to their business segments and geographies, Veeva does not present segments in the classic operating segment sense, but rather it presents product area disclosures. And the two product areas are R&D solutions and commercial solutions. R&D solutions was $1.46 billion in fiscal 25, which was 53% of revenue and plus 23% year over year. This was driven primarily by the Development Cloud and the Quality Cloud. And R&D solutions covers clinical trials, regulatory submissions, and more across the pre-approval lifecycle. With commercial solutions, this was a $1.29 billion business in fiscal 25, which was around 47% of revenue and an increase of 9% year over year. This business is centered around the commercial and data clouds. It supports CRM, omnichannel engagement, and sales analytics post-drug approval. It is worth noting that subscription services year-over-year increase attribution was plus $274 million from R&D solutions versus plus $109 million from commercial solutions. So R&D solutions are contributing around 2.5 times more. Looking at geographies, there are 4 regions and they're all growing year over year. North America drives scale, while Europe is the fastest growing and Asia Pacific is lagging. Over the past 3 years, Europe has grown at around a 16% CAGR, which is slightly ahead of North America's 15% CAGR, and APAC is in the mid-single digits. As of fiscal 25, North America was 59% of revenue and increased 17% year over year. Europe was 29% of revenue and increased 19% year over year. And Asia Pacific was 10% of revenue with a 6% increase year over year, while Middle East, Africa, and Latin America were 2% of total, which was a 9% increase year over year. Looking at research and development, and since competitor IQV does not separately disclose R&D, we'll focus on Veeva and Salesforce instead. In absolute dollars, Veeva spends far less than Salesforce given its smaller scale, but its R&D has grown steadily over time, reaching roughly $750 million trailing 12-month compared to Salesforce's multi-billion-dollar R&D budget. Now, where Veeva stands out is R&D intensity, as Veeva consistently reinvests around the mid-20% range of revenue versus Salesforce in the mid-teens. And historically, Veeva converted that R&D into strong revenue growth more efficiently than Salesforce, though efficiency has compressed in recent years as growth has moderated and investment ramped. Now, a strong company is only part of the equation. You also need a great industry, which is the healthcare and life sciences software industry. And overall, I rate this industry as neutral to slightly attractive. While barriers to entry are relatively low for software, barriers to scale are structurally high due to regulatory complexity, deep domain expertise, and embedded compliance workflows, which naturally limit the competitive field. Supplier power is low, and customer bargaining power is moderate given some competitive alternatives. Competitive rivalry is also moderate, with horizontal software companies like Salesforce, Oracle, and Microsoft competing in parts of the stack, though Veeva remains strongly differentiated as a pure-play life sciences platform. The threat of substitutes sits in the moderate range, largely tied to how disruptive AI becomes to traditional software workflows. My view is that critical, deeply embedded platforms like Veeva should continue to thrive, even if some lower value tools become redundant over time. Veeva frames the life sciences software TAM at a 20 billion plus opportunity, with current penetration around 16% based on their fiscal year 26 expected revenue. That highlights just how early in the overall software adoption curve they still are across biopharma and other markets, especially medical devices. And then over time, management expects the shift to meaningfully go towards clinical within the development cloud, growing from around 20% of revenue today to around 30% by 2030. Looking at some growth forecast, the broader biopharma and medtech industry is expected to grow around 6% CAGR through 2030, and the life sciences software layer below that is forecasted faster, roughly in the 6 to 13% CAGR range, depending on the segment and source. Against that backdrop, Veeva's own revenue outlook stands out, as analysts imply roughly $5.3 billion in revenue by 2030, which equates to around a 14% CAGR from fiscal 25 levels, placing Veeva's estimates at the top end of the industry forecast. There's also two optionality levers that I find intriguing with Veeva. First is Veeva AI, which will enable workflow automation and new modules, which could drive higher ACV per customer and would help them versus relying solely on new customer growth for expansion. The second is Crossix, which has evolved from a bolt-on acquisition into a structural growth driver within commercial solutions. And what this does is it links pharma marketing activity directly to patient outcomes in a compliant way and creates a high margin recurring measurement business with upside from audiences and targeting as digital pharma spend grows. You can think of Crossix a bit like you might think of a Doximity. Looking at the competitive environment, I've identified three main competitors. The first is Salesforce, ticker symbol CRM. This is a horizontal CRM platform that Veeva was originally built on, and it still competes with them in commercial CRM, but lacks life sciences specific workflows and that regulatory depth. Second, IQVIA Holdings, ticker symbol IQV. They are strong in clinical data, analytics, and services with some overlap in clinical operations, but they're a little bit more of a services-heavy business versus Veeva's pure SaaS model. They also recently resolved an 8-year legal dispute with Veeva, so now customers can easily integrate each other's software, data, and services. The third is Oracle, ticker symbol ORCL. This is another broad enterprise software player with some healthcare assets like Cerner and cloud infrastructure, but it's less purpose-built like Veeva. I then like to compare Veeva versus their competition on some customer loyalty metrics and some financial metrics. And on customer loyalty, Veeva leads at an 81% customer loyalty score versus Salesforce 75% and Oracle 72%. They also post a very strong NPS of plus 32, although Salesforce is actually higher at plus 36 and Oracle trails at plus 11. What this does show is that the industry overall gets strong scores, and Veeva seems to have strong loyalty and satisfaction among their customer base. Veeva's also materially outperformed peers on both growth and profitability, with a 17% 5-year revenue CAGR versus 15% for Salesforce, 8% for IQV, and 9% for Oracle, while also generating a best-in-class 40% free cash flow margin versus 26%, 13%, and 15% respectively. That translates into far higher capital efficiency, with Veeva posting a 28% 5-year average ROIC versus low single-digit to low teens returns for competitors. These financial metrics were compiled through Fiscal AI. Next, we'll tackle 9 questions that outline Veeva's quality growth profile. Keep in mind, this is mostly backward-looking data. The first section, predictability, is 5-year trailing revenue stability at least 0.84, and this is my weighted portfolio average. The closer to 1.0, the better. This is a yes, as the 5-year trailing revenue stability score for Veeva in their latest fiscal year is 0.94. Then I like to ask, is 10-year stock-based compensation adjusted free cash flow linearity at least 0.77, which is also my weighted portfolio average? Yes, again, at 0.95, and it's actually the highest among the last 10 or 11 companies that I've tracked. For profitability, the first question is 10-year median gross margins at least 40%, which indicates at least some pricing power, operating leverage, or differentiation. And for Veeva, this is a yes. It was 71.6%, which is even higher than my weighted portfolio average of 64.9%. Then is 10-year median SBC adjusted free cash flow margin at least 15%, and it's a yes again at 23.7%, which is also higher than my portfolio weighted average of 22.5%. The next section, growth and conversion, is 10-year revenue CAGR at least 5%, which is my bare minimum baseline for long-term compounders. Yes again at 24.3%. And then is 10-year free cash flow per share CAGR at least double digits. And this is yes again for Veeva at 36.9%. And then to round out this section is 10-year median free cash flow conversion at least 75%. And Veeva gets another yes with a 10-year conversion ratio of 149%. And the value creation section is 10-year value compounding rate, which is just the reinvestment rate times the ROIC, at least 10%. And the answer is yes again at 16.9%. This is particularly impressive as it shows just how fast that Veeva can grow its intrinsic value each year based on how much it earns on its money and how much of those earnings it reinvests. And then is adjusted ROIC trending up if low or holding steady if already high? And Veeva scores a yes again as its latest fiscal year of 29.8%, while it's not trending up from an elevated 2019 to 2022. It does remain stable to slightly elevated from historical time periods of 2016 to 2017. In summary, Veeva is the first company on my podcast to earn a passing grade on all quality growth questions, which is very impressive to see. We'll now dive into a high-level overview of Veeva's 3 financial statements. Looking at revenue growth has decelerated from the low 30% in 2021 to 2022 to mid-teens more recently. In 2025, their growth was plus 16% year over year, which suggests a more mature growth profile, but still solid double-digit expansion. Margins remain structurally strong. Gross margin is in the mid 70% and has steadily increased over time. Operating margin is back to mid to high 20% after falling off in 2023 to 24, and net margin is also back in that same range. COGS is primarily driven by platform hosting and delivery cost. So think of third-party cloud infrastructure such as AWS for Vault and Salesforce for legacy CRM. COGS as a percentage of revenue has been stable from around 27 to 29% from 2021 to 2024, but then improved to 25% in 2025. I believe as Veeva fully migrates off the Salesforce platform onto its own Vault CRM on AWS, gross margin should structurally benefit over time due to lower platform fees and that greater cost control. The 2 main OpEx line items are R&D and SG&A. As a percentage of gross profit, R&D stepped up from around 28% in 2021 to around 34 to 37% now, while SG&A ran from around 34 to 37% through 2024 and then declined to 31% in 2025. One thing also worth noting for Veeva is net financing cost, which is just interest expense minus interest income. And then you also can divide it by net income to get a percentage. And these are actually favorable for Veeva, as interest expense is $0 with no debt, while interest income has grown materially. So that equation is actually negative and meaningfully impacts reported net income, as this percentage has increased to around 29% in 2025. So it is worth flagging as a non-operating boost to earnings. Looking at the balance sheet, their top assets are cash and short-term investments, which have grown to now around 70% of total assets. And accounts receivable have trended down to around 14%, with goodwill a low 6%, which is great to see, as that's well below my 30% rule of thumb threshold, and the NYU database's industry average of 43%. Current unearned revenue is the largest liability right now at around 84% of total liabilities, reflecting those prepaid subscriptions. And then it's followed by accrued expenses at around 5% and accounts payable at around 2%. Operating lease liabilities are only around $76 million, which is about 7% of annual operating cash flow. Veeva's financial stability ratios like debt to equity, cash to debt, and debt to free cash flow look great. And bottom line, they operate an ultra liquid, debt-free balance sheet anchored by subscription prepayments. This is also reflected in the cash flow statement, where operating cash flow is primarily driven by recurring subscription cash collections with front-loaded billings. And cash flow from operations has also steadily increased since inception, with a 32% 10-year CAGR as well. As mentioned previously, free cash flow conversion is really high, and the 10-year median has been around 149%. The one area of the cash flow statement to watch out for is SBC intensity. If you look at it as a percentage of revenue, it's about 15% trailing 12 month, which is above the industry average of 2% and my ideal less than 10% threshold. And then if you look at SBC as a percentage of operating cash flow, it's around 34% trailing 12 month, which is above my own portfolio and benchmarks. CapEx has remained structurally low, with capital intensity ratio, which is the percentage of CapEx of revenue, having a 10-year median of 0.9%, which is well below my 4% threshold and right at the industry average of 0.9%. So this confirms that Veeva is a highly asset-light, software-driven model with minimal reinvestment needs for physical infrastructure. Now, let's talk about who's actually steering the ship at Veeva and whether their incentives line up with long-term shareholders. The first thing to note is that Veeva is founder-led. Peter Gassner is their CEO and co-founder and has served in this role for around 19 years, which gives the company long-term strategic continuity and deep domain expertise in enterprise life sciences software. While the company remains founder-led, there has been some notable senior executive movement, including Frank Defesh, who is the former SVP and GM of Vault CRM at Veeva, as he left over the last few years to become SVP and GM of Life Sciences at competitor Salesforce, which is certainly interesting to note. And then in terms of cultural signals, employee commentary points to some internal friction following a 2024 PTO policy change that reduced unlimited PTO to a capped 15-day structure, which some former employees cited as a contributor to turnover. On the positive side, though, Veeva does get good reviews for being a remote-first company, and this is something that I can also appreciate. In terms of employee sentiment, I looked at Glassdoor. Their recommend to a friend was 59% and around 1,500 reviews, which is quite below my database median of 72%. Their CEO approval and positive business outlook were higher at 71% and 67% respectively. Turning our attention to how executives are paid here, their compensation structure consists of a few key elements. The first is base salary. They have a largely flat annual base salary structure for executive officers. And during fiscal 2025, the annual base salary of all their NEOs was $425,000 per year. The good news is that Veeva has generally not offered a short-term cash incentive bonus program to their NEOs, and there's no current program as of fiscal 2025. They also have equity awards, which is an important part of the executive compensation program, as they grant RSUs and stock options from time to time to employees under stock plans. Then there's also this special equity retention grant, and except for the CEO, all executive officers received special long-term equity incentive grants in fiscal 2023. Looking at compensation KPIs, Veeva is a little different in that their compensation is largely equity-based and not directly tied to operating KPIs like revenue or margin targets. So instead, outcomes are primarily linked to long-term stock performance, which does reduce the risk of management gaming near-term financial metrics, but increases exposure to share price volatility and market perception. Looking at their CEO's total compensation the last 3 years, in 2023 and 2024, he made a modest $392,000 and $421,000, although in fiscal 25, he actually made $172 million, and this was mostly driven by option awards. Looking at my red flags checklist, what to watch out for is just that grant timing volatility, which complicates year-over-year comparisons. But I do like that there's no non-GAAP incentive metrics for the CEO and no discretionary annual bonuses. In terms of capital allocation, I know that there is some sentiment on X around Veeva having a less than optimal strategy here. But interesting enough, Morningstar does give them an exemplary rating, citing strong alignment with a high return compounder in reinvestment mode, prioritizing organic growth with a fortress balance sheet. For me, I'd probably rate it just below exemplary and more standard. Despite excellent fundamentals, shareholder returns have been minimal to date. The 10-year median total shareholder distribution to free cash flow ratio is 0%, with only modest buybacks, around 7 to 9% of free cash flow. And while dilution from SBC has been manageable, diluted shares are rising a couple percent a year. That said, there is a new $2 billion buyback program, around 5% of their market cap, that was announced in January 2026. So this could mark a shift in capital allocation strategy around. Looking at deal making, they follow more of a tuck-in acquisition approach. Notable examples were Crossix at $427 million and Physicians World at $55 million in 2019, and these expanded their commercial cloud capabilities. Really, since then, M&A activity has been minimal, so they are firmly in my low reliance on M&A category. Checking their alignment, insider ownership is meaningful. The CEO holds around 7 to 8% of outstanding shares, and depending on the source, insider ownership is at least 8 to 10%. Institutional ownership is also really high at around 88%, well above my 75% benchmark. And I do like that management has some long-term goals. They've recently reaffirmed a $6 billion revenue target by 2030 and rising towards a subscription mix of 87%, along sustained 35+% non-GAAP operating margins. Let's now dive into a few key metrics that are critical to monitor for Veeva. The first is subscription revenue growth, and I look at this overall and also broken out by R&D and commercial. This KPI validates core demand, share gains, and progress towards that $6 billion 2023 target. Subscription revenue has continued to grow steadily across both R&D and commercial segments, with R&D now the largest contributor. The second KPI I look at is average products per customer, and Veeva does break this out by R&D and commercial. This measures that platform expansion, upsell success, and pricing power. Platform expansion remains strong, with average products per R&D customer rising from 2.61 in 2021 to 3.44 as of Q2 26, and commercials increased from 3.95 to 4.10 over the same period. I'll also throw out a third KPI that I saw in an article from another investor that I liked, and it is ARPU, average revenue per user, by product area. All right, now let's wrap with some valuation and technicals. For Veeva, I use a hybrid valuation approach. Intrinsic methods serve as my long-term compass, grounding fair value in the company's durable cash flow generation, while multiples provide a snapshot of current market sentiment. Given Veeva's current life cycle as a scaled, profitable SaaS compounder with high recurring revenue and strong free cash flow generation, Intrinsic and cash focused valuation methods are going to be my most relied on for assessing fair value. And then I'll also use EV to EBIT plus R&D to normalize profitability for that heavy reinvestment into innovation. I ran a 10-year DCF on January 27th, 2026, and got a fair value of $267 per share versus the current price at the time of $218, which represents around a 22% margin of safety. Key assumptions include a 9% required return, 2.5% terminal growth, and 4 years of analyst estimates, along with 13.8% free cash flow growth for the next 6 years, and then that 2.5% thereafter. This gets us to about $2.32 billion in free cash flow by 2030 and results in an implied return of about 11% annually. I then looked at forward free cash flow yield, and I used the market cap version, which is free cash flow per share divided by price per share, and Excel's forecast sheet to take the last 10 years of free cash flow per share data and project the next 5 years. This model shows that free cash flow per share should grow from roughly $6.47 in 2025 to $10.89 by 2030. And at today's price, this implies a 3-year forward free cash flow yield of 4.08% and a 5-year forward free cash flow yield of 4.90%, both well above Veeva's historical norms, as their 3-year median is 2.77%, 5-year median 2.61%, and 10-year median of 2.26%, indicating that the stock is meaningfully cheaper on a cash flow basis than it has been historically. On an EV to EBIT plus R&D basis, Veeva currently trades at a 17.8x multiple on trailing 12-month figures versus a 10-year median of near 28x and 5-year median of 27.9x, placing the stock below its historical valuation. Now, not saying it will, but if the multiple does revert back to its 10-year median, the implied stock price would be $312, representing 43% potential upside. Compared to Salesforce, it currently trades at a premium, as Salesforce is at a 14.6x multiple, although their multiples have been very close the last several years. Before we get to a verdict, let's quickly walk through the technical setup at the current price of $218. On the 1-year daily chart, Veeva is below its 200-day EMA, which currently sits around the low 250s range. Price is also below the shorter-term EMAs, and this confirms that the stock is in a short-term downtrend. On the longer-term 5-year chart, price is sitting around the 200-week EMA, roughly in the low 220s area. Historically, this moving average has acted as a major long-term support zone for Veeva during prior drawdowns. So while the short-term trend is weak, the long-term trend is now in a key decision zone where buyers have stepped in before. On the stage analysis side, my model flags Veeva in a stage 4 downtrend on the 1-year and in stage 3 on the longer-term 5-year. Looking at their anchored volume profile in the 5-year chart, there's a heavy volume node in the roughly 215 to 230 range, which lines up almost perfectly with the current price and the 200-week EMA. Above that, there's lighter volume until the high 260s to 280s, which suggests that if Veeva can reclaim trend, price could move relatively quickly back into that range. Looking at short interest, this sits at around 3.24% of the float, so using my framework, that is under 5% and bullish. Now that we've reached the verdict, here's how I'm thinking about Veeva. My base case 4-year total shareholder return from 2026 to 2029 is a 20+% CAGR, driven by 3 levers. A starting free cash flow yield of around 3.8%, which is their current 26.5x price to free cash flow multiple today, around 8% free cash flow per share growth CAGR, and I use trailing 12-month Q3 26 free cash flow and diluted shares outstanding. And then I have analysts projecting roughly $2.04 billion in free cash flow by 2029 and included a negative 0.1% buyback yield, which is their 10-year median, to forecast $167 million diluted shares outstanding by 2029. And then a multiple change of around plus 3.2% per year, which is just simply valuation gradually normalizing from that 26.5x today back up to around 31x, which is their 5-year average. Now, running this through a bull, base, and bear case. Bull case would be a free cash flow per share CAGR of around 15 to 16%, and a valuation multiple change of around plus 5 to plus 6%, and this gets you a TSR of around 24 to 26%. The base case I discussed above, and that is a 21% TSR. And then the bear case would be around a free cash flow per share CAGR of only 5 to 8%, and a valuation multiple change of around negative 1.5% to negative 3%. And this would get you a total TSR of around 5 to 10%. This stock is essentially a tug of war between Veeva's platform expansion and AI-driven TAM upside versus CRM competitive pressure and slowing growth normalization. In the bull case, Veeva successfully gets off the Salesforce platform and sees increased optionality with Crossix and AI agents, driving sustained double-digit free cash flow per share growth toward their 2030 goals. And in the bear case, commercial CRM share pressures from Salesforce and slower adoption of new modules or headcount reductions driven by AI cap growth keeps valuation multiples permanently lower than historical norms. Anchoring everything together, Veeva scores a 75% on my 33-question quality checklist, putting it in the 84th percentile. It is also the first company in the podcast to pass every major quality growth category. Valuation looks compelling versus historical multiples, and technically, while the stock remains in a short-term downtrend, it's hitting right on major long-term support near the 200-week EMA. Overall, this is a buy for me right now. For risk management, I'm anchoring to long-term volatility with a 2 to 3x 5-year ATR, defining downside risk around $186 to $170, where I'd consider exiting for risk management. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Veeva Systems both insightful and actionable. If you enjoyed today's episode, drop a comment or take the episode poll. For real-time updates, follow me on X at Invest091. Join me next when we'll dive into Intercontinental Exchange, ticker symbol ICE, with our favorite guest, Shivam Kishan. Until then, keep your investments smart.